If you have a pension in the UK, you need to listen to this. You could be overpaying on your tax bill by hundreds, maybe even thousands of pounds, and not even know it. In this guide for the 2026 tax year, we're going to break down exactly how pension tax relief works, and crucially, how you can make sure you're not leaving your hard-earned cash behind.
And we couldn't do this alone. This entire presentation has been developed in partnership with the brilliant tax experts at My Tax Accountant. These guys live and breathe the UK tax system, so you know the information you're getting is top-notch.
So I want to ask you a question, straight up. Just think about it for a second. Is it possible you're accidentally overpaying tax every single month? I know, it sounds a bit crazy, but for a huge number of people in the UK, it's a reality they're completely unaware of.
And look, this isn't just a guess. The numbers are staggering. We're talking about higher earners in the UK missing out on hundreds of millions of pounds in unclaimed pension tax relief every single year. Just imagine that for a moment. All that money just sitting there waiting to be claimed.
So, here's our plan. We'll kick off by figuring out if you're missing out. Then we'll get into the nitty-gritty of how tax relief actually works. We'll cover the allowances you need to know, shine a light on some common tax traps, and, most importantly, we'll finish with a clear action plan for claiming back what's yours.
Right then, let's dive into Section 1. Are you missing out? This is all about the hidden cost of simply not checking your pension relief properly.
So who needs to pay extra close attention? Well, while anyone with a pension gets tax relief, the people most at risk of not getting their full entitlement are those earning over £50,270 a year. Also on this list are self-employed people, company directors, and, this is a big one, anyone in what's called a relief at source pension scheme. We're going to explain exactly what that means in just a moment.
And that leads us perfectly into Section 2, how tax relief works. You see, to get why this money gets missed, you first have to understand that there are two different systems at play. But first, what even is pension tax relief? Well, put simply, it's the government topping up your pension for you. Think of it like this. It's a refund of the income tax you've already paid, but instead of going into your bank account, it goes straight into your pension pot. It's genuinely one of the best perks of saving for retirement in the UK.
Okay, now this slide is absolutely key to understanding everything. On the left, we have relief at source. With this system, your pension contribution is taken from your pay after you've been taxed. Your pension provider then automatically claims back the basic 20% tax for you. But, and here's the catch, if you're a 40% or 45% taxpayer, that's all you get automatically. You have to physically claim the extra 20 or 25% yourself. Now, compare that to the net pay arrangement on the right. Here, your contribution is taken before you're taxed. This means you get your full tax relief at your highest rate right there and then. No extra steps, no forms to fill in.
Let's make this a bit more real. Let's meet Alex. He's a self-employed consultant based in Manchester, and he earns £70,000 a year. That makes him a higher rate taxpayer, so he's entitled to 40% tax relief. Now, his personal pension plan is a relief at source scheme. Let's say he pays in £10,000 a year. His provider automatically claims back £2,000, that's the basic 20%. But for years, Alex had no idea he was supposed to be claiming the other 20%. Another £2,000 back from HMRC himself. He was literally leaving thousands on the table year after year.
And here's a quick pro tip. If you're listening to this and thinking, gosh, I have no idea which scheme I'm in, don't panic. It's actually really simple to find out. Just give your employer or your pension provider a quick call or email, and they can tell you straight away.
Right, so now you know how it all works, let's talk about how much you can actually save into your pension, tax efficiently. These are the rules of the game for the 2025 to 2026 tax year. The big number you need to remember is £60,000. That is the standard annual allowance. It's the maximum that you and your employer combined can pay into your pension in one tax year and still get that lovely tax relief. It's a pretty generous limit, but stay with me because there's a really important detail coming up.
And that detail is this. The rule is actually £60,000 or 100% of your qualifying UK earnings, whichever is lower. So if you earn, say, £40,000 a year, the maximum you can get tax relief on is £40,000 for that year, not 60. It's a simple rule, but one that catches a lot of people out.
But wait, it gets even better. Have you ever heard of the carry forward rule? This is an amazing feature. If you haven't used all of your annual allowance in any of the last 3 tax years, you can carry it forward and add it to this year's allowance. This is a real game changer for people who might get a big bonus or just want to make a larger one-off contribution to their pension. Okay, moving on to a really crucial section. We need to talk about some common pension tax traps. These are the little pitfalls that can easily trip you up, especially as you start thinking about retirement.
So this next point is for anyone out there who's over 55. Are you thinking about maybe accessing some of your pension cash flexibly? Taking out bits and pieces as and when you need it. If that's you, then you absolutely need to listen to this next part.
You see, the moment you start to take taxable income flexibly from your pension, you can trigger something called the Money Purchase Annual Allowance, or MPAA. And what this does is it slashes your annual allowance from that generous 60,000 pounds all the way down to just 10,000 pounds a year. That is a massive drop, and it can really hurt your ability to keep saving if you're still working.
So, what triggers it? Well, taking taxable lump sums or starting to take an income from a Flexi Access drawdown pot will do it. But, and this is so important, there are safe zones. Taking only your 25% tax-free cash lump sum does not trigger the MPAA. Neither does using your pot to buy an annuity or cashing in a very small pension pot worth less than 10,000 pounds. Knowing the difference here is absolutely vital.
And here's another trap that catches so many people. It's called emergency tax. The very first time you take a taxable payment from your pension, HMRC often requires your provider to use an emergency tax code. This usually means you pay way too much tax up front. Now don't panic. You can get this money back, but it's not automatic. You have to be proactive and claim it from HMRC.
Which brings us beautifully to our final section, claiming what you're owed. This is your practical, step-by-step action plan.
So, if you're a higher rate taxpayer and you've discovered you're in a relief at source scheme, what do you do? Well, first, double-check that's your scheme type. Then, you've got two main options. You can contact HMRC directly, often through their website, or, and this is what most people do, you can simply claim it through your annual self-assessment tax return. You just need to tell them the gross value of your contributions.
And I saved one of the biggest pro tips for last. If you're having a light bulb moment right now, realizing you've been missing out for years, you can backdate your claim for up to 4 previous tax years. That could be a really significant amount of money waiting for you. Please, whatever you do, don't leave it on the table.
Now, before we finish, we just need to say that all the information in this presentation is for general guidance. It is not and should not be seen as a substitute for professional financial advice that's tailored specifically to you and your situation.
The world of pensions and tax can feel complicated, and it's so important to get it right. For expert help that's built around your circumstances, we highly recommend you get in touch with the professionals at My Tax Accountant. You can see their phone number and email on the screen now. You can also read their full detailed article on this topic on their blog. And finally, don't forget to subscribe to their YouTube channel for more fantastic tips like these. Thanks so much for watching.